So last week, the Federal Reserve made their big October announcement, and we've given it a week. We've let the dust settle. We've let the markets react. And how did they react? What's going on? What do we see happening now in the future? How do we predict what might happen? What are the things we're tracking? What does it all mean to you as a potential homebuyer in this market? That's what we're going over today. Welcome back to the Informed Homebuyer Podcast. I'm your host, as always, Rich Curtis. I have my co-host with me, Dave Miller. How's it going, Dave?
It's going well, Rich. Thanks for having me. Looking forward to this one today.
Yeah. All right. So catch us up. What happened at the Fed meeting? What did he say? What did he announce? And did it meet our expectations? Was it different? What happened?
Yeah, and so Rich, I think the anticipation was it was going to be a quarter point drop in the Federal Reserve's federal fund rate, which we saw happen. And I think it's important to note that, well, let me back up a little bit. We anticipated that mortgage rates had been improving slightly as a run up to the Fed announcement. That was kind of baked in. We were anticipating, I want to say there was over a 90% consensus that they were going to lower rates. There was, some talk that it could have been even higher than a quarter, a few people. But the consensus was it was going to be a quarter point drop by the Feds. Then after they drop the rates, then you find out how the board members voted and what the discussion was. And so it wasn't unanimous that we were going to drop it a quarter. There were some outliers and folks that thought, one in particular thought they should leave rates the same and shouldn't lower that rate by 0.25%. And then some saying that we should have lowered by 50 basis points and get on the track to getting, the Fed fund rates, continuously brought down into their goal into the 2% range. So again, which doesn't mean mortgage interest rates. It's just the financial levers that the Federal Reserve is pulling. And, I think you do a good job of explaining the difference between, inflation and unemployment and the lever that they have to pull, and they're stuck right now. The reality is where inflation isn't coming down at the rate that they want it to, or it's just flattening. We're in a government shutdown, so we're not seeing any new data come out. Not that data would be good for, until it was revised 90 days later. But nonetheless, that data that they make decision on isn't flowing like it was.
Yeah, and I think that's an important discussion to get into, those sort of dual levers and why we're stuck. But before we get into that a little bit more on sort of the brass tacks of interest rates, I think people keep getting frustrated when we get these reductions in the Fed rates. This is 2 times now that they've reduced the rate, and 2 times that mortgage interest rates have gone up. And people keep saying, well, what the heck? What is going on? So just to reiterate, the federal funds rate is not the mortgage interest rate. Federal funds rate is the short-term borrowing rate for government debts and businesses to move money around the economy. It is not the mortgage interest rate. The mortgage interest rate is more closely tied, and we'll dig into this a little deeper in the episode, to the 10-year T-note and the mortgage-backed securities market. So we had a response, Dave, in the mortgage-backed securities market and in the bond market that did push mortgage interest rates around, not exactly the way we would like. So if you can tell us, I'll throw up on the screen a little chart that you've prepared for us. If you can tell us, so what happened with mortgage interest rates and why we think it happened, what pushed it around?
Yeah, and I think so. If you look to the right here, Rich, and the reason why I went with a year-to-date chart here is you can see all the way to the right takes us all the way to, to today, really, where we see the last two. I know it's hard to see, but we're looking at that 101 number. Is we're sitting just above a floor of support. And so the idea here is the bond market's making a decision now. Is it going to go up or is it going to go down? I know it sounds cliche. It's got to go one direction, but you can see that it's been trending flat really since September. We're in a pretty tight range. So they're talking about this is a step. We're either going to take a step down or a step up. And ideally, we're going to see some green candlesticks going up to a point where we will see us getting close to that 101.5 and ideally penetrate that, which means our mortgage interest rates will have some relief and they'll come down a little bit. So green is good for mortgage rates, red is bad. And we're just sitting in a tight window here, not really sure which direction they're going to go. They're, looking at the overall broader economy and waiting for what's going to transpire to see which direction these go. The good news is we've been hovering and bouncing and staying above that 101 number for almost 3 weeks now.
So staying
So
pretty stable. And certainly, we'd like to see it go in the direction of trending up so we can see mortgage rates come down. But the opposite is also a potential. It's fair to say that the general public doesn't have a real good way to track mortgage backed securities. If I get out and start Googling around or trying to look for these charts figured out, this is more of a proprietary software thing that you as a lender track, correct?
that is correct. Really difficult to get this data, and quite frankly, people get caught in the weeds. If rely on someone, a mortgage professional in your local market, or myself, if you're here in our market, this is what I pay attention to all day, every day. And the other reality is if you've already made the decision you're going to buy a home and you're shopping for a home, don't get caught up in this. We're seeing very tight swings, and don't think, oh, shoot, maybe I should kick this down the road and buy in 6 months because by then rates will probably be 5.5. No, that's not the case. It's possible. Yes. Anything's possible. It's just as possible that rates would go up to 6.5. So, you just don't want to get caught in the weeds in looking at this stuff. It's good to look back and see that we're trending in the right direction. And for those of you that are holding on and looking for, COVID era interest rates, those aren't going to happen either. And I think you and I always say, if those do happen, we got bigger problems, that we just don't want to deal with.
Yeah, I think so. And so, since this data is not really publicly accessible, not easy to digest, let's talk a little bit about the 10-year T note. That is something
Yeah.
someone can Google. What's the yield on the 10-year T note right now? So, give us a little education historically on how that 10-year T note yield relates to mortgage interest rates and what happened over the last week that we can kind of track how that pushed rates around.
Yeah, that's a good point, Rich. So if you were looking at the 10-year mortgage, T note, right now, I think the last I looked, we were trading at 4.089, and so we have a ceiling of resistance at 4.1, and similar. What we're trying to do is hold below that 4.1, and if we do so, and we see it fall below, ideally we're going to end up below 4 and in the threes, and that's where we're going to see some relief in mortgage interest rates. There's a spread when you look at the T note, and it varies between 2 and 3%. So right now, we're roughly 2 1/8 to 2 1/4 above the T note. So T note's trading at 4.1. Add 2 1/8 to that, you're looking 6 1/4 roughly. Mortgage interest rate range. Obviously, credit score, down payment. There's a lot of factors that go into what an individual's um, mortgage rate would be, but that's kind of the barometer that we're using, and that's something that you could take a look at, and then understanding what that spread is. But that's where we're sitting today. And if you look historically, the T note, go back a month, 2 months, was quite a bit higher. So I feel like we're sitting in an area where we're at least steady, and similar to that bond chart I showed, we are sitting steady, and we're just waiting to see what's going to happen.
Yeah, and just to reiterate what Dave said, that's not an indication of what your interest rate would be. That's just an iteration of what sort of the general interest rate environment is. To know what your interest rate would be, you have to speak to a trusted professional and go through the pre-qual and give a lot of sort of information so that it can be tailored to who you are in your financial situation. But this gives you something that you can track as all the noise is coming at you from the news. And you'll hear people saying interest rates are going to go through the roof. You'll hear people saying interest rates are going to drop through the floor. You can Google for yourself what the current yield today is on the 10-year T note. Add, as Dave's saying, 2 1/8, 2 1/4 percentage points to that. That's roughly where we're sitting on interest rates. So that 10-year T note is the more publicly available thing that you can look at home to get a sense of this. And why this is important for two reasons. One, because of the tariff insanity and the trade war insanity and all of that people have been losing some confidence, both nationally and globally, in the U.S. economy, which means they've been having to increase that yield a little bit to try to attract investors. Now, the reality is that's not happening a ton yet, but a lot of people are worried about it happening more. And that's when you hear people talking about this cracking in the bond market. That's what they're worried about, is that if the economy continues to be unpredictable, good's okay, bad's even kind of okay, unpredictable, not good. They might have to increase the yield, how much they're offering on the 10-year T note to attract buyers. And that makes the T note yield go up. That would be bad for mortgage interest rates. The opposite of that is the people who are saying, oh, the Fed's going to start quantitative easing, and that's going to have the Fed buying up T notes and mortgage-backed securities, which will bring the yield down on the T note, because now we have a readily available and steady buyer for T notes, and then that'll be good for mortgage interest rates. Both scenarios are to some degree equally viable in this environment, but also it's good to know neither scenario is actually really happening on the ground. When you're getting all that information thrown at you, these are people just spitballing ideas of where they think this thing could go. But what Dave just showed you, going back to that chart on the right, you can see not wild swings. If you look sort of to the center left, you got a big swing there in the middle, right? And that's probably
Yeah.
Liberation Day, right? Day, right after
Yeah,
Liberation.
that's exactly what that was. Yep.
Yeah.
And so, and then you could see is when we have these big precipitous drops, it takes a while to claw our way back. And it's a steady increase. So if you go to the next chart, Rich, you could see that we dropped, and then you could see like the way you're looking at how long it takes over time to gradually work our way back. And there's intraday, intra-week, monthly inflections there. But it does take a while, and it's just good to see, at least for now, when we look at September, maybe the end of August, beginning of September, moving forward, the last 2 months that you see there on the chart is we are in a tight range. And the one thing we don't want to see is these wild swings. And sometimes people love it when we have this giant green candlestick that goes up, then mortgage rates come down, but that's not necessarily the way we want them to happen in a quick swing. We want them to gradually work their way up, so that it's not as volatile.
Yes. And when you're hearing on the news that the sky is falling, but then you look at this, you're like, well, wait a second, nothing's actually happening. I mean, that's really the truth. Is interest rates from September to now mostly a nothing burger. There's not a whole lot going on at the moment.
Yeah. And Rich, I've been doing this a long time, and I can't tell you, like, there's times where interest rates are steady, and there was a point in time where the Federal Reserve, they met several times and they didn't do anything to rates. And people know I'm in the mortgage business, and they lowered rates a quarter point last week. And people that I know I don't see very often, oh, I bet you're busy right now. Feds, rates are down, so I'm sure your phone's ringing off the hook. The way it's presented, the way it's consumed, is that it's a mortgage interest rate. The rates just dropped a quarter percent. Everyone just wants it to be what it is that they want. It's not mortgage rates like you talked about. It's the
Yeah.
Federal Reserve rate, the intraday rate that banks are borrowing money from one another. And so that's not a one-to-one. It's going to take us some time to see mortgage rates improve. And, there's even predictions that, they may stay low sixes, the six range, well into 2026. I personally think that something's going to transpire with QT here. We might see mortgage rates hover in the high fives, which, like we always talk about, an eighth, a quarter point difference. 5.875 sounds way better than 6 1/8 or 6.125. It's
Yeah.
that front number that gets everybody excited. You don't want to be at a dinner party and say my rate's 6.125 and have your uncle say, oh, well, mine's 5.875. What you don't know is how much did he pay to get that 5.875, how many thousands of dollars, because it sounds better.
Yeah. We have a whole
So
episode we did 2 weeks ago on that. Why one of our myth busting episodes, why the lowest interest rate isn't always the best interest rate. So maybe we'll link to that at the end, because it's a good one to get some more context on the point you're making there, which is a really important one.
right.
Um,
And so yeah.
so getting into, so what moved the market? So the quarter point drop, everybody expected them to do that. So the market had already kind of baked that in. The 10-year T note, the mortgage-backed securities, the stock market in general is not going to move based on that quarter point reduction. It already baked that in. And if he just does what he says he's going to do, everything stays pretty much the same on Fed announcement day. In fact, if all he did was go to the podium and say, we said we're going to do a quarter point reduction, we did a quarter point reduction, I'm not taking any questions, and walked away,
Right.
nothing would have happened, right?
Right.
It's
It's the
everything he
language.
says after
Yeah.
that.
It's the language, and it's the minutes afterwards and the discussion that really tilts the scales one way or the other.
Yeah, and I
Um,
think this time Powell, who's usually very even keel and not very concerned seeming, he expressed more genuine, perceptible concern in his comments, and I think that's what moved the market. Yeah, I think we instantly saw a big drop in the Dow and the Nasdaq right after the announcement, right?
Yes, yes, that is correct. And him saying that I think the language was that lowering rates next time is not a foregone conclusion. Like
Yeah.
um, just even though the market is already anticipating, it's like any betting odds that there's a 70% chance that the Feds are going to lower a quarter percent. Well, that's much better than 50-50, and we still have, some time until the Fed meets and hopefully nothing crazy happens, but inflation is still out of control. Still higher, elevated, and unemployment's down or unemployment's up, employment's down. So they're stuck in a quandary. They're really stuck in a rock and a hard place, really, in terms of what to do.
Yeah, and I think that was the language that he put more of a sharp point on that than he has at any of the meetings in the past. One, someone asked him a follow-up question. He said, "Look, I always say it's not a foregone conclusion, but this time I'm saying more than that. It really is absolutely not a foregone conclusion." He acknowledged dissent among the committee, not necessarily contentious or virulent debate, but just dissent, meaning the the reading of the available economic data. And remember, folks, not all the economic data is available because of the government shutdown. So they also entered this meeting a little bit hamstrung with less backwards looking data than they normally would have. But it just they weren't in agreement about which way to go. And he really acknowledged this, to Dave's point, the stuck between their dual mandate. Their mandate is to try to keep maximum employment for the American people and inflation very low. And usually they're only having to work on one of those or the other. So if inflation's out of hand, they raise interest rates and they start letting securities fall off their balance sheet or selling off securities on their balance sheet, right? If the economy is doing good and inflation's okay, but unemployment is going crazy, then they go the opposite direction. And now you have them both at the same time, and they only really have that one lever to pull. He even said that we only have one tool and we can't solve both problems with our one tool. And so he is acknowledging that they are in a bit of a stuck spot, and the path forward is not clear.
Yeah, and I think for people here hoping that they lower rates and that stimulates the economy, stimulates employment, but we are not seeing, the everyday consumer is not seeing any relief in price and the cost of goods. Um,
You mean the
I don't.
prices haven't come wildly down?
They have not come wildly down, which is a double whammy. It's fine if prices are staying up and employment's up and people are getting raises and everything looks rosy in the job market, then you can pay for, higher price, goods. But we're not in that situation right now. It's actually moving in the opposite direction. And so it's, and I think for you, Rich, on the supply side, the prices of real estate, some people expected that, with the rates having come down a little bit, there's going to be droves of people wanting to sell their house, or, people that have the lock-in effect that maybe want to sell and go buy. I don't know that we're seeing that.
Yeah, we're not. And I think, yeah, so I think that's a good place to go here is let's talk a little bit about what's happening in the real estate market because of this, or really, unfortunately, what's not happening in the real estate market because of this. And then we can talk a little bit about what we see happening sort of the end of this year and beyond. But yeah, really, as of now, the market is just as much stuck or in stasis as it was before. Relatively low inventories, a lot of listings coming to the market and then delisting, a lot of buyers backing out of deals. There's a lot going on, but not a lot getting over the finish line in the real estate market right now. Cancellations are up, delistings are up. And so, although if you look at one side of the numbers or the other, you're like, oh, things are moving. If you actually look at closed transactions, things are really just putting along right now. And there's no real economic data or anything other than hopes and dreams on the horizon that I see right now that's going to change that. The things that would change that would be, okay, so the Fed right now has been in quantitative tightening, like we said, just letting securities fall off their balance sheets. If there really starts to be blood in the streets and the economy is doing really bad and they decide, the heck with it, we're not going to worry about inflation, we need to move some money in here because people are hurting, and they start buying up securities, well, then all of a sudden you've got this ready buyer for the T-note. The yields come down on the T-note, mortgage interest rates come down. And then the thought is, okay, if interest rates come down, all the buyers will jump off the fence. But the counterpoint to that argument is, well, what's happening in the economy then? If we're doing that, it means, and this is, Dave always says, be careful what you wish for on the podcast. If we're doing that, Dave, it means people are losing jobs, right? And people don't have employment stability, and buyers probably aren't going to move rapidly and en masse into the marketplace because they're not feeling like they're going to have the money they need to
Right.
make
Yeah.
that mortgage payment at any interest rate.
Yeah, and consumer confidence goes a long way, and it's pretty safe to say anyone that buying a house today, 2 years ago, 5 years ago, didn't know what was gonna happen 1, 2, 3, 5 years in the future. When you
Yeah.
buy a house, you buy it and you make that decision based on your own personal scenario and how your confidence level, overall consumer confidence level in the economy at that point in time. Because as we know, things can change, but it's a lot harder to make a decision to buy when things aren't very rosy at all. I mean, I think
Yeah.
everyone's smart enough to know that, and they've all seen it, that, job losses can come, mass layoffs can come. Nobody's usually insulated from that. But at some point, you'll be paralyzed. You won't do anything if you're always worried about that. But when things seem steady, the company you work for seems like it's steady and things are humming right along, that's when folks are making these decisions to buy. And right now, there's just a lot of what we talk about, fear, uncertainty, and doubt. And that's scary for a lot of people.
Yeah. And I think, especially if you're someone who's not in the housing market and you're thinking about moving in, that's a big financial decision. It changes your entire financial landscape. It's a big commitment. It's a big liability on your balance sheet at that point, especially right at the, long-term houses can be an appreciating asset and most often are and become an asset. But on the day you purchase them, they're more of a liability on your balance sheet than an asset at that moment. And people don't tend to pile on big liabilities when there's a lot of, fear, uncertainty, and doubt, to your point. So I think the idea that a large amount of the buyer pool is going to move off the fence as interest rates come down here, I think interest rates would have to be wildly low to make that happen. And if they're wildly low, what it took to get there will mean they still won't do it. So I don't see that scenario happening.
Yeah, and then the other part of the other side of the coin to that, Rich, is who's selling their property and those that had the lock-in effect. Are these folks that are retired that have stable pensions or, fixed income that they can count on? And so maybe they bought their house, 10, 15 years ago. They refinanced into a 3% rate. They know they can't get a 3% rate, but they've had some great appreciation and they're just willing to sell their house and move on because life is happening around them. They want to be by grandkids or kids or whatever the reason is that they want to, move up, move down, move into different areas. Is at a certain point, you're not going to be prisoner to your interest rate anymore. And those are the folks that are going to be motivated sellers,
Yeah, and I
especially
think that's
those.
the segment of the market, pardon me, that frees up if interest rates come down. It's that
Yeah.
financially stable, potentially retired, more grandparent age person who has been trapped by their interest rate, and they're like, okay, that new rate's good enough. It's not great, but it's good enough. I'm going to get on with my life. Those transactions will keep the market chugging along. That segment of things will come. I think the first time buyer, pool isn't jumping off the fence anytime soon. And so I think, and then I'll get Dave's take. I think the most likely scenario moving forward for a little while here is what we've been having, which is the market is just chugging along in this kind of stuck stasis. Deals are happening by people who are either in a really good financial position, or at least a stable one, and the rest of the other segments of the market just aren't moving. And I think that's stuck in the same way the Fed's a little bit stuck, the real estate market's stuck
Yeah.
with them due to this lock-in effect. And I think that stasis is the most likely thing until something really wild, until a wild swing happens and the bottom drops out, and then, maybe the market isn't moving because buyers are coming off the fence. Maybe the market's moving now because we're back to short sales and REOs, moving,
Yeah.
moving the market because of the job loss. So I hope that's not where this goes eventually, but that is one of the potentials that could see a lot more volume entering the market space.
Yeah.
Would there be deals to be had? Yes, but only by, really financially secure people. So it still sort of screws the same people who've been screwed all along, the first time buyers,
Yeah.
the people who are on the ragged edge of affordability. I don't see a lot of relief for them right now.
Yeah, no, I don't either. I agree with you. I think the other piece of this is if, we've seen so many listings come on and be delisted. I would be curious to know how many of those properties that got delisted didn't even receive an offer.
Yeah.
Um, because part of that as a buyer is you see these properties come on and maybe they weren't realistic about their sales price, but it does not hurt if it meets all your criteria and you're looking, throw in an offer and maybe a lower than what they have it listed for with the guidance of your agent to say, hey, fair market of this might be a little bit less than what they're listed for. Let's see how motivated they are to sell.
Yeah.
But until there's that motivation to sell, or the homes that are coming onto the market are actually receiving offers before they, I mean, oh, I don't want people walking through my house this weekend. I haven't had any offers yet. Let's just wait till next spring. We'll sell it then, or whatever it may be.
Yeah. Or just
I
not responding to offers. This is a weird one. I always counsel my buyers. I don't usually go around town splashing around ridiculous, like stupid lowball offers. That's not good for anybody.
Mhm.
But coming in under asking, that's fine. But something crazy lowball, not a great idea. And the risk there has always been that somebody sort of takes their ball and goes home and says, you know what, I'll sell my house, but I'm not selling it to you for any price because you pissed me off, right?
Right.
And it's a rare individual that actually does that. I mean, in 21 years, it's been one or two people up until this year that have really done that. I'm not talking to you. I'm not selling my house to you. I'm not even going to respond to your offer. I mean, 4 or 5 different times on both sides of the deal, just in the last 6 or 8 months, I've had somebody be like, I'm not even responding to that. I don't need to sell this house. I don't even need to talk to these people, which is a really weird outcome, a really weird place to be in the market. And frankly, not real great for negotiations. I always tell people just get the conversation started, get numbers moving around,
Right.
and we'll eventually get somewhere to the end, and we'll see if the end works for you or not. But
Well,
there's just
well,
not that motivation. People won't respond
no,
in a lot of cases now.
right. But I think part of that, Rich, is where you're a little bit different. And I really encourage people, like if you're in a local market, is you're not just going to write a low ball offer and send it over. You're going to have a discussion with that listing agent, say, here's what my buyers are thinking. Whether you advise them way or another, should we submit this offer at this price, or this is what we're going to do, and get a sense of feel like, what they may say, don't even bother, right? Like,
Yeah.
then you're not going to offend the seller. They may say, well, you know what? That's a starting point. Send it over. I'll talk to the sellers and let's, see if, we can meet somewhere. But it's part of that discussion and know, if it's crazy low ball and the buyers aren't willing to go up a penny, do you want to waste your time writing that offer if it's not even going to be entertained? I know you work hard for your buyers, but you're going to have a conversation and at least get a feel for how low can you actually go and have it be at least looked at or not, upset the other side.
Yeah, it's just wild it's wild the number of times this year that I've had agents say don't bother, or we just got 2 or 3 offers at this level and they didn't even respond to any of them. I'm so sorry. They're not going to respond. It's wild how much of that's going on, and that just speaks to that lack of motivation in the seller pool, which is making coming to the middle. Market value. People always ask me, what's the market value of my house? Well, market value of our house is what a willing seller is willing to accept for their property, and a willing buyer is willing to give for that property. That's really it. We use comps and data to give you an idea of what the marketplace is offering and what the marketplace is accepting, but it really comes down to what they're willing to give and what you're willing to accept. And never before in the 21 years I've been doing this has that delta been so wide as it is in this market. So.
Right. And, we had an appraiser on a couple of weeks ago that reiterated that there's a few properties that will come on that are just such the right place, the right location, the right condition, that there will be a buyer for that property if it's priced somewhat reasonable, like just
Yeah.
within, and so, and
Yeah,
we've
that's the
seen
weird
that.
thing.
We've
There are
seen,
still multiple offers. We've had a couple in the last couple of months, you and I, with clients that got 4 or 5 offers because they
yeah.
sort of did everything right, or it was a real special, unique property. But that's the exception rather than the rule in this market.
Right. And so if you're someone that's sitting on one of those properties and you're ready to move for whatever reason, you might get what you're looking for. But if it's just a, nothing special property that, got to be careful if, do you truly want to sell it or not?
Yeah, and I think this just goes to where the market is right now, and I think stuck is the right word for the real estate market, and for the economy itself isn't stuck. Things are moving, but our ability to affect the way they're moving is stuck at the moment. And so I think anybody that's giving you a real confident, this is where it's going, this is what's happening, is full of bull. There is I'm the least confident right now in any prediction about where the market's going that I have been in 21 years in this business. Like Dave said, high likelihood that we think is high likelihood we'll see rates in the low sixes, maybe high fives, Q4 this year, going into Q1 next year. But it is just as likely something wacky happens and they shoot back up. And we really just try to come on here week after week and give you the data, tell you where it's at right now, because we really have to be making our decisions in the now, because it's very hard to predict. And in the now, again, in a market like this, we fall back to those 5 real estate fundamentals. I'll put that video on the screen at the end of this. It's maybe not the market for people who are on the ragged edge of affordability or throwing everything they have and selling their surfboards and their snowboards and everything just to try to buy a home. It's probably not the market for those guys right now. But if you are a well-capitalized buyer with good savings and emergency fund and stable recession-proof employment, and you have a long time horizon for holding the property, those 5 fundamentals, if you meet those, then yeah, there's going to be some interest rate opportunities here, and you can pick your moment to move in. If you're not that person yet, and you're more that person on the ragged edge, this is a market to be working your way towards those 5 fundamentals rather than hanging on every news announcement, every salacious bit of the sky is falling, rates are going up, rates are going down, every executive order the president flings off his desk. You're better off spending your time and your mental attention on getting those 5 fundamentals in line so that you are a buyer who can purchase any home in any market and make an informed choice.
Yeah, very good point. I agree 100%.
All right, I think that's a good place to wrap it there, Dave, unless you have anything else on this one.
No, I think that was it. I think that's a perfect place to wrap, and, shoot, in, a few weeks we'll be having another conversation and seeing what the, Fed ends up with, and, where they come out with the numbers and how did that affect mortgage interest rates based on what the Fed fund rate ended up at.
Yeah, and I will put my neck on the line. I actually, this is my prediction. Dave, I'll bet you a beer on this one. I am leaning more towards stasis next time. I'm leaning more towards them not doing anything.
And I'm leaning towards a quarter. I'm leaning towards a quarter point reduction. So we'll see.
All right. Well, we'll see
Yep.
who owes who a beer on the next one then.
All right. Are we allowed to drink that on the pod? I know on TV you can't show yourself
No,
drinking a beer.
no, on YouTube it's totally fine. People drink all the time. Yeah.
Okay.
I think
All right.
there's a lot of doom and gloom. I think this might be more. Maybe we ought to just start doing these with a beer or a cocktail and increase the production value here.
Good. I'm with you. Sounds good.
All right,
Hopefully
everyone,
you're buying that one though.
There you go. Thanks
Yeah.
for watching, everybody. I hope you got some value out of this. If you did, hit that like button, click subscribe, hit that little bell icon so you don't miss another video to keep you updated and informed on what's going on in the housing market. Until next time, I've been Rich Curtis.
And I'm Dave Miller. Thanks, Rich.
See you all next time.